The future of finance is a topic of immense interest and speculation. Understanding the forces shaping this landscape is crucial for investors and policymakers. We will explore the projected growth of world currencies, stock markets, and cryptocurrencies, including the decline of the US dollar, the rise of the Chinese Renminbi, and impacts of generative AI and climate change. By analyzing current trends and potential disruptions, we can gain valuable insights. The financial landscape of 2050 will likely be vastly different from today. Understanding these trends is paramount for making informed investment decisions. This journey will equip you with the knowledge to navigate future uncertainties. By understanding potential trajectories, you can make more informed decisions for success. The US dollar has reigned supreme as the world's reserve currency for decades. However, this dominance is being challenged. Emerging economies are increasingly promoting the use of non-dollar currencies. The Chinese renminbi, in particular, is steadily gaining traction. Projections suggest that the dollar's share of global reserves could fall to 40 to 45% by 2050, a significant drop from its current level of around 60%. This decline can be attributed to several factors, including persistent US deficits and concerns about the US political landscape. Meanwhile, the renminbi's share of global reserves is projected to double to 5.6% in the next decade. While this is still far behind the dollar, it represents a significant shift in the global financial order. However, the renminbi's ascent to global dominance is not guaranteed. China faces its own set of challenges, including geopolitical tensions and concerns about transparency. The euro, another potential contender, is also grappling with issues such as political fragmentation and slow growth in the eurozone. The evolving dynamics between these major currencies will have profound implications for the global economy. Understanding these trends is crucial for investors seeking to diversify their portfolios and mitigate risks in an increasingly multipolar world. The rise of artificial intelligence, particularly generative AI, is poised to revolutionize various sectors, and the stock market is no exception. Generative AI, with its ability to create new content and automate complex tasks, has the potential to unlock unprecedented levels of productivity and innovation. This technological leap will likely create both winners and losers in the stock market. Companies at the forefront of AI development and implementation are well positioned to reap significant rewards. Tech giants in the US and China, with their vast resources and research capabilities, are leading the charge in AI innovation. Investors who can identify and invest in these companies early on stand to benefit significantly from the AI revolution. However, AI's impact on the stock market extends beyond the tech sector. Industries ranging from manufacturing and healthcare to finance and transportation are being transformed by AI-powered automation and data analysis. This widespread adoption of AI will likely lead to increased efficiency, reduced costs, and new business models, ultimately impacting stock valuations across various sectors. Understanding the transformative potential of AI and its implications for different industries is crucial for investors seeking to capitalize on the opportunities presented by this technological revolution. Climate change is no longer a distant threat. It is a present reality with tangible economic consequences. Extreme weather events, rising sea levels, and disruptions to agricultural production are already impacting businesses and economies worldwide. Investors cannot afford to ignore the risks and opportunities presented by this global challenge. The transition to a low-carbon economy will require trillions of dollars in investments across various sectors, from renewable energy and sustainable infrastructure to climate-resilient agriculture and carbon capture technologies. Companies operating in these sectors are well positioned to benefit from this global shift towards sustainability. However, climate change also poses significant risks to certain industries. Companies heavily reliant on fossil fuels, for instance, face an uncertain future as the world transitions to cleaner energy sources. Investors need to carefully assess the climate risks associated with their portfolios and adjust their investment strategies accordingly. Navigating the financial implications of climate change requires a proactive and informed approach. Investors who can identify the winners and losers in the transition to a low-carbon economy will be better positioned to weather the storm and capitalize on the opportunities presented by this global challenge. Section 5. Black Gold's Future, Oil Demand and Currency Impacts. The future of oil demand is a subject of much debate. While some projections suggest that peak oil demand will occur within this decade, others, particularly those from OPEC, anticipate continued growth in demand, reaching 120.1 million barrels per day by 2050. This divergence in forecasts highlights the uncertainty surrounding the future of oil. Factors such as the pace of the transition to electric vehicles, the development of alternative energy sources, and economic growth in developing countries will all play a role in shaping oil demand in the coming decades. If demand remains robust, it could bolster the currencies of oil-exporting countries, providing them with continued economic leverage. However, a decline in oil demand would have significant consequences for these economies, potentially leading to currency depreciation and economic instability. Investors with exposure to oil-dependent economies need to closely monitor these trends and adjust their portfolios accordingly. The future of oil is inextricably linked to the global energy transition. Understanding the factors driving oil demand and their potential impact on currencies is crucial for navigating the complexities of the global energy market. Amidst the shifting sands of the global economy, Asia and the U.S. tech sector stand out as potential bright spots for investors. Asia, particularly emerging markets like India and Indonesia, is expected to experience significant economic growth in the coming decades, driven by a burgeoning middle class and rapid industrialization. Investing in companies tied to this growth, such as those in the consumer goods, infrastructure, and technology sectors, could prove lucrative. Meanwhile, the U.S. tech sector, fueled by innovation in areas like AI, cloud computing, and biotechnology, is expected to maintain its position as a global leader. Investing in established tech giants and promising startups in this space could generate significant returns. However, it is essential to note that both Asian markets and the U.S. tech sector are not without their risks. Investors need to carefully assess factors such as political stability, regulatory environments, and competitive landscapes before making investment decisions. By carefully navigating these complexities and conducting thorough due diligence, investors can position themselves to capitalize on the growth potential of these dynamic regions and sectors. Cryptocurrencies, once a niche interest, have exploded onto the mainstream financial scene. Bitcoin, Ethereum, and a plethora of other digital assets have garnered significant attention and investment. Proponents tout cryptocurrencies as the future of finance, highlighting their decentralized nature, potential for high returns, and innovative applications of blockchain technology. However, the cryptocurrency market remains highly volatile and speculative. Regulatory uncertainty, security concerns, and the potential for market manipulation pose significant risks to investors. Furthermore, the environmental impact of cryptocurrencies, particularly those that rely on energy-intensive mining processes, is a growing concern. While the future of cryptocurrencies remains uncertain, their potential impact on the financial landscape cannot be ignored. Central banks are exploring the development of central bank digital currencies, which could revolutionize payment systems and monetary policy. Blockchain technology, the underlying technology behind cryptocurrencies, is also finding applications in various sectors, from supply chain management to voting systems. Investors considering venturing into the cryptocurrency market need to proceed with caution, thoroughly research the risks involved, and only invest what they can afford to lose. The future of cryptocurrencies remains a fascinating and evolving story, and only time will tell what role they will ultimately play in the global financial system. Central banks and governments play a crucial role in shaping economic growth and financial stability. However, they face a challenging balancing act in the years to come. After years of expansionary monetary policy, most central banks are expected to begin raising interest rates and reducing their balance sheets to combat inflation. This tightening of monetary policy could slow economic growth and potentially lead to market volatility. Simultaneously, governments worldwide are grappling with high levels of debt, limiting their ability to implement fiscal stimulus measures. This fiscal constraint could hinder public investments in critical areas such as infrastructure, education, and healthcare, potentially impacting long-term economic growth. Navigating this complex landscape will require careful coordination between central banks and governments. Policymakers will need to strike a delicate balance between controlling inflation, supporting economic growth, and ensuring fiscal sustainability. Investors should closely monitor policy decisions and their potential impact on different asset classes. As we look ahead to 2050, the investment landscape appears both exciting and uncertain. Traditional stocks will likely continue to play a significant role. Cryptocurrencies and technologies like AI and blockchain present new opportunities and challenges. Building a resilient portfolio requires a balanced approach. Consider sectors poised for growth, such as technology, healthcare, and renewable energy. Exposure to emerging markets like Asia could provide diversification. Allocating a small portion to cryptocurrencies could be considered for high-risk tolerance. Remember, the cryptocurrency market is highly volatile. Thorough research and diversification across different crypto assets and a long-term investment horizon are essential. Stay informed, adapt to changing market dynamics, and diversify across different asset classes. Consider potential risks and rewards to navigate financial markets and achieve long-term goals.